How's it going? It is Friday, July 8th, and this is the final hour of expiration experimental trade. And this is episode number 50. This is the 50th attempt at this trade. We're currently running at a win rate of about 62%. There have been 10 no trades. So those are trades where we just didn't find an opportunity and decided not to trade. And I'm committing to go to 100 trades, or 100 attempts. Now, the first 50 attempts, we did them using the SPX, options on the SPX. Now, let me just explain exactly what we do. What we do is we are trading the very final day, and in here, the very final hour of expirations of options on S&P. In this particular case, we've been concentrating using options on the SPX index. And so that's what we did for the first 50 trades. For the next 50, we're going to be doing options on the E-mini S&P futures contract. So there are slight differences. There are some good parts to this and bad parts. Well, there's no real bad parts. The good part is that there is no pattern day trader rule with the E-mini S&P futures contract. You don't have to worry about taking 3-day trades in a 5-day rolling period ever if you have an account under $25,000 or if you only have $25,000 of margin left. In fact, you could trade 1,000 times in a day and never get tagged as a pattern day trader with the E-mini futures. So that's good. The other great thing about the E-mini futures is that it is actually a real thing. It is an actual contract that you can trade by itself. In other words, there is an actual underlying. With the SPX, there is no underlying. So what that means really is that there's volume associated with the underlying so that you can do some analysis about where price might go. With the SPX, there's no such thing. So there is no way to do any kind of volumetric analysis. And virtually all of our analysis is based on volume and using volume profile. So what are some of the detractors of the E-mini futures compared to the SPX? Well, for one, SPX, although it is a much larger contract, almost 3 times as big as the E-mini, the cost or commissions on the SPX are quite a bit lower for the options contracts. They're about 65 cents on average, 50 to 65 cents per contract. And then, of course, there are exchange fees, which amount to maybe another couple of dollars. So that means that the kind of trades that we do typically cost about $6 per instance of the trade that we put on. We're typically putting on butterflies, which involves 4 contracts. So if you add up all the fees and everything, it comes out to about $6. On the E-mini, it's quite a bit more expensive. It ends up being about $21 per contract. So, or per butterfly, not per contract, but it really depends on what broker you have and what arrangement you have with that broker. It can be as little as $11 and as much as $21. So that's a pretty big range. If you're with Interactive Broker, for instance, you're going to be on the low end of that range. If you're with Tastyworks, you're going to be somewhere in the middle, probably around $16, $17. If you're with Thinkorswim, you're going to be up in the upper end, around $21. However, if you become a volume player on Thinkorswim, you can negotiate that down and get down around $15 per fly. So what that really means is that when you're trading this, and this is the case with the SPX or any commission, you need to take the commissions into account when you're trading. Just like when you're taking or doing another strategy, you have to take slippage into account and other things. So every trade, we need to overcome about $18 to $21 of cost, where in the SPX, we only had to overcome about $6 of cost. So about 3 times more. So that's one of the detractors. Another that is a detractor to some people is that with the E-mini futures, if you hold it into expiration and any of those legs are in the money, you're going to get assigned a futures contract. And this is easily remedied in a couple of ways. One is you simply don't let it go into expiration. And if you're very close to expiration and you're in profit, then just exit. Or if any of the legs are in the money, then just simply exit the trade. No harm, no foul, everything's cool. If you let it go into expiration and you get assigned, you'll get a futures contract deposited into your account probably within 5 minutes after the close. Usually a little bit faster than that, usually within a couple of minutes. And so if that happens and you have a very small account and you can't support the margin, then what you need to do is you need to exit that right away. Of course, getting out before the market closes and it expires is the easy remedy. So that's what I would recommend. I would just say, just get out, is no big deal. With the SPX, it's cash settled. So you're not really worried about getting assigned anything. They simply do the debit or credit into your account with cash. No assignment at all. And both of them, there's no early assignment because they're European style options. So it doesn't affect you until after expiration. That's why it's so easy to take care of the E-mini. The big thing for small traders is that there's no pattern day trade rule. And for all traders is that we have volume to do our analysis. And it's a slightly smaller contract. So it's a little bit easier to manage and use. Overall, I like the counterparty risk and the availability of the E-mini futures. The fact that it has volume is kind of like a game changer. And the other very, very big thing that the E-mini futures has going for it, although in this particular trade it's not as big of a thing, is that it trades 23 hours a day, where the SPX is only traded during market hours. So that means that you can take a position anytime after that opens, which would be at 6 o'clock at night, all the way right up to the close. So for 23 hours a day, 5.5 days a week, even on Sunday night, you can take positions with options on the E-mini. For the SPX, you're limited to the 6.5 hours that the market is open between 9:30 and 4. So that is a huge, huge thing. And that provides you with incredible flexibility in your trading. So overall, I think that the E-mini futures is a far superior asset under most conditions for trading 0 DTE. And so what we're going to do is we're going to, for the next 50 instances of this final hour trade, we're going to be using the E-mini S&P futures. Now, let me just say that, I had originally started this service last year using the E-mini futures. And I was able to take a small account and basically triple it in size. And so I wanted to prove that you could get around these problems, these made up problems of high commissions and assignment. So there you go. And so we are going to be doing that again in our service. We're going to put the emphasis on E-mini futures because of that extra added flexibility that it has. And which is particularly good for people with small accounts, even though you have that extra commission. The benefits of this strategy make it easier for you to trade. All right. Now that we got all that out of the way, we're not doing the E-mini today. We're actually doing the SPX because this is the 50th trade that we've done with that. And then we'll compare the next 50 trades with the E-mini compared to what we did with the SPX. I'll also keep tighter. In the beginning, I wasn't like that concerned about keeping very accurate records. I just want to do a sort of a win-loss type of thing, and just see what kind of range of returns that we could get. But on this next 50, I'll keep very accurate records, and then we'll go from there. All right. So that's everything. That is everything there is to say about. I guess one more thing is that this is more of an experiment than this being an actual service within the 0 DTE service, the 0-DTE service. Although some people are treating it like it's, a de facto another trade that we do. We're trying to test it out to see if it will be a trade. And so therefore, I don't recommend that you put a lot of money into this trade, trade minimally. we're trying to learn about the trade, trying to learn about the price action at the end of the day, and then how these contracts work and how they behave. That's the whole purpose of it. And we have another experiment that we will have going on where we'll be collecting data on intraday reversals. And I think that that's also going to be a very impactful study that we'll do. Now, does that mean that because I'll be putting on trades on that everybody should just start piling in? No, you have to recognize what it is. Stick with the, the standard trade that has been developed in the service, and then use that as our, I guess you could say, our standard. It's our standard. At the risk of sounding redundant. All right. Oh, we have a bunch of comments already. And let's see, we have Jim, how you doing? And Dan has showed up. Will do, how you doing? And Chris. All right. Well, I think we already covered that, Brian, right? Is there a possible problem if you don't close out a mini? I can just walk away from the SPX. Only if it is, as I said earlier, if any of the legs are in the money. If any of the legs are in the money, then you will get assigned a contract. All right, so that's important. So all you have to do is just don't let anything that's in the money expire. Pretty simple. All right. TNT says assignment with E-mini will cause margin violation for many because the contract requires 14K of margin. Actually, it's a little higher than that. I think it's 15.6K of margin to hold. Many of the brokers will even close you out early of E-mini options by their risk department. That is true. So if you're with Webull or Robinhood or even Tasty Trade, unless you have an agreement with them and understanding, or they have switched that auto risk management feature off, they will probably get you out of that trade as much as 30 minutes, maybe even an hour before the close. Well, I think it's about 30 minutes. I'm not sure exactly what their timing is on it. So you could be in that trade, and if they see you in the money, they'll get you out regardless of where you are. Now, you could be in profit or not in profit, and if it ends up in profit by the time it gets to expiration, it doesn't matter. You're out, and whatever you were at that time, whatever your real unrealized profit is or loss at that time, that's what you get. Now, with Thinkorswim, you can negotiate with them and prove to them that you have knowledge of this and that you're expecting it and that you're going to manage it and not allow it to go to expiration. And if it does, you plan on relinquishing or closing that option, or I'm sorry, that futures contract as soon as it hits your account. And even if you have a smaller account, as long as you get rid of it, they'll be okay with that. So it depends on your broker. I know that IB will allow you to do this as well. I don't know about Tastyworks. It seems like they want like hands off of everything and just sort of automate it like Robinhood or Webull does. But with Thinkorswim, really, it's kind of like the pros alternative trading platform. You can negotiate things there with them. All right. It's 5 to 10 minutes within the close. Okay, that's good to know. So I guess then you just get out before then, right? For those of us who still want to trade SPX, will you continue to give us price difference? Yes. Yeah. And I will, obviously, if we're taking a trade during the day, then you can just as easily take the trade with the SPX as you can with the E-mini. That's completely up to you. And doing the price difference, that's a trivial matter. All you have to do is have both the SPX and the E-mini up in front of you on two charts, and you can look at what the price difference is. If it's under 5 cents, then there's really nothing to do because then they will essentially have the same contracts. If there's 5 cents difference or more, then you just offset it one strike for every 5 cents. It's pretty simple. I know that a lot of traders, they don't want to do that work. it's it's like also getting out of a trade before expiration. It's like, oh, I've got to exit the trade. I can't just, sit back and throw my head back and just let it happen by itself and let them take care of everything? Oh, what kind of strategy is this, Ernie? Well, if you want to make money, look, no one ever said that trading was easy. As a matter of fact, my mentor is fond of saying that trading is the hardest way to make easy money. So if you just follow the rules, follow your discipline, do what you have to do, you'll make money. If you're trading with a strategy, obviously that has some edge, and if you have the right kind of management, risk management, profit management, you're going to do well. But if you're lazy and don't want to learn, your chances are really squat. Squat. You'll get eaten up. Is says, "Hi Ernie. So we traded the ESU 22. What time do they expire? They all expire at the same time. The options all expire at 4 p.m. Eastern time. Just wondering what time of day we need to be sure we close." So that's all you have to know, is that at the end of the day, the options expire at 4 p.m., whether it's the SPX or the E mini. All right. So that's pretty simple. You can find out the price if you were to Google something like the CME fixing price for the S&P. So do CME fixing price, and then you'll be able to go and see at the end of the day exactly what the closing price is, because they post it within minutes after the close. Exactly. Sometimes you can't tell on your platform exactly what the closing price was. Now, this is an easy way to do it. Just go to CME fixing price. Oh, it has already answered my question for me. All right. So TNT is asking, correct. They get closer to each other as quarterly expiration approaches. Right now, they're about 4 points. Yeah. And actually, this is a new quarter, too, for the E-mini contract. And I'm surprised that they are so close, because normally on the new quarter, there's a much bigger difference, usually 8 to 10 points. And then as they get closer to expiration, in this case, the current E-mini futures contract will expire in September. The current one, or the one that we just passed, expired in June. And as you get right down to expiration, right near the end date, they're only about a point or so apart. Right now, they're only about 4 points, which is very unusual this early in the life cycle of a futures contract. So that's kind of interesting. Joe says, yes, I want to continue to trade the SPX. Will your alerts continue to apply to SPX price levels? I think I just explained that. If we trade inside of the trading day, you can just as easily trade the SPX. Even if we take a trade outside of market hours. Sometimes with the E-mini, we might take a trade before the market opens, right? Because we think we might have an advantage. If the trade is still valid when the market opens, you can easily take that up with an SPX trade, right? Same thing. It's the same thing, right? It's not like it's different. Just, has different characteristics associated with it. All right. Brian misses the lobster man. I'll have to go to the beach again. How you doing, Juan? And you're welcome, Gloria. How you doing, Greg? All right. We got all the comments out. Fantastic. Let's take a look at the market. Back to the charts. All right. So we had a rather, I would say, a volatile day. We had about a 50+ point range, 52 points, I think. In the beginning of the day, after a market report came out, the jobs report came out, the market dropped pretty hard. And it looked like that's what we were going to have, a down day. It got down to this LVN, the green line, which is a low volume node, and the market reversed. All right. So then it came up and it basically stopped right about where the open was, which seemed interesting. Okay. So then it came down again, and it looked like we were going to be range bound, like we have been in the past couple of days, very range bound. But on this next leg up, it just kept on going, and then came down and went back up. And now we're going down again. So the big question is, are we going to go down to the bottom of the range again? Now, we're currently inside of a big volume node that we call T1. You can see my scenarios that I drew earlier today around 7:30 or so in the morning. This was S1. S1, I thought we were going to stay somewhere inside of the volume node, that we would move up initially and then come down. And then in the case that the economic reports were negative, I thought we would come down to the LVN and possibly move down even further through it. All right. And so you can see that right here. And then I thought we would go further through it if they were really negative, but apparently they weren't negative enough because they bounced off of the LVN. So I guess I kind of missed uh, the analysis. I mean, the analysis I think was okay. It's just we're in one of those situations now where the market is it's just acting weird. It's just weird. Don't understand. And the interesting thing is that this down move, this very sharp down move, right after the employment report was released, was confusing to some because it was a fairly positive employment report. You know, one might assume then we're in this kind of opposite world type of event where this may be putting pressure on the Fed to raise interest rates because there's lots of jobs out there and people are getting jobs. So they say. So why it went down, I guess you can explain that away. But then how do you explain why it went up? I don't know. You know, that's why it's a little bit confusing. So now we've got about 37 minutes left in this market, and I know that I've been yapping away, but I was really yapping away trying to see, well, what's going to be the result of this right here? Are we going to start moving back down towards the 3,900 level? I think we are, and the reason, or to a level that level that includes the high volume mark. So let me see if I can adjust this here. And look at I'm bringing up the options chain here. Hold on. So one thing I'll say is that the volume was particularly low today. So we're in a kind of an illiquid market, and that could also have some reasoning behind the erratic behavior of the market, that it can be pushed around up and down all over the place. Typically, we see things that are more up in the, for instance, here, a high on the call side. The highest volume contract that we have right here is 3,900, and it's only 12,000 contracts. And at 3,925, only 11,000 contracts. That is super low, very very low. And then on the put side, we have 3,850 at 15,000 contracts, and then again here at 3,900, 15,000. So it appears, if you were to take both puts and calls together, it looks like 3,900 is where the market wants to end up. So in that case, what we would probably do is, try to shoot for that area. Now the question is, will we overshoot or not? I don't know. So let's see. If this is 3,900, we could probably put a trade just below 3,900 with the expectation that we come down there and shoot for that mark. I didn't see any real high volume up here in the 3,915 range. So perhaps something centered on, I don't know, 3,895. See what that would give us. That's interesting. Even at 38.95, the probability of touch, it's still only 30%. So let's give that a shot. We'll buy a fly right there. See what that looks like. All right. We can close this one. And so for $30, we can we have a trade that has a potential for about 250 bucks, 230 bucks. That's not bad. It's close to 1 to 8 risk to reward. And it would cost us about $25 or $30. See, the debit right now is about fluctuating between 45 cents and 50 or 60 cents. So maybe we can get it for, I wonder if we can get it for 45 cents. Let's find out. Maybe 45 cents is too much to pay. Let's try a little bit less. 40 cents. All right. So it's going to cost us, cost of the trade is $30.68, including commissions and fees and all that other stuff. So we have to end worth more than 60 cents. All right. So I put it on. We don't know if it'll show up here if it gets filled, but I'm not sure if it will get filled. If it doesn't, I'm really not willing to pay much more than that. So if we get a couple of ticks up, we'll probably, get filled. All right. So Craig's saying, since I am doing the ES, do I need to make sure that I am out? Well, only if there's any of your trade that's in the money. All right. So I'm going to put this same trade on in the SPX. Because I said that I was going to do SPX trade, right? So I have to put that on my Fidelity account. So that was 38.85 center strike, 510 wide. This is the last SPX trade. Let's see if we can get in it. And Fidelity wants 50 cents for that. So that's $50 to make almost $600. Let's see if that filled. Yeah, it filled. So we have about 14 minutes and it needs to do a drop about 10 points to pin. Let's see if it does. See if I can draw up a graphical representation of what that trade will look like. Right, 38. Okay. It's the P&L line is jumping all over the place. Let me show you. It's just jumping all over the place. And this is probably due to the lack of liquidity. What does it look like on the SPX options chain? There's a fair, it's kind of low. Usually we have a couple of contracts that are in the 60,000, 70,000 contract range, but we really, the biggest one we have is like 40,000, 41,000. So liquidity is definitely on the low side. What happened to the box? There it is. So got 9 minutes. In 9 minutes, will it drop down into this? So I did a poll earlier today saying, hey, are we going to set new highs? We were right here, right about this area. Did it about 15 minutes ago. Will we set new highs, or will we come back down into the range? And overwhelmingly, people chose back down into the range. So let's see if the members are right. Robert wants to know, when the P&L bounces around, is it worth putting in a relatively high limit close order, hoping it will catch it? I don't think so, because when the price is, or the profit line is moving all around there, that's because there's a lack of counterparty orders. There aren't people out there, so it's searching for price. And if there aren't people placing orders, there's nothing for it to grab a hold of. That's why it's bouncing all over the place. Um, and people aren't going to be putting out errant orders and giving you a great price because they like you or anything. They're, if they're going to enter a price, they're going to enter their good price, and their good price isn't going to be your good price. Philippe from Belgium, how you doing? Jim says, seems like more volume above the price than below it. What made you decide to go south? The membership. We took a poll saying, well, what are we going to do? Make new highs, or are we going to move back down into the range? And the membership decided that it was moved down back into the range. So essentially, this is like it's like a probability trade. You put your strategy somewhere within the probability of profit. About a 50% probability of touch, and then you figure that you're going to move into it about half the time. And if you don't, well, then you lose. If you do, then you can possibly make some halfway decent profit and potentially pin the trade. So that's basic. And of course, we'll also throw in our own analysis and based on the market structure and try to uh, get that to our advantage as well. But when you're right down to the last few minutes, it really is more of a probability trade. But sometimes you get lucky when other people make market orders on their trades. Rare event, but it can happen. Yeah, that's true. That is true. And there's nothing wrong with hanging a trade that you think is ridiculous. I've made some very large trades that way. Just hanging it so far out of the money, so ridiculous, thinking no one's ever going to pick this up. And then you go to lunch or something, or go read a book or go do something else, and you come back and you say, "Oh my God, I got filled." It's happened. I mean, if it doesn't cost you anything to put on a ridiculously priced trade, then why not? It won't cost you anything, and if you get hit, then there's a good chance that you'll make some money, or at least get into a trade at a ridiculously low price. So there's less than 5 minutes to go. It looks like it's just, it doesn't want to go our way. I'll tell you, the last several weeks have been thin, to say the least. I mean, we're going to end up with 50 trades above 50%, but, you know, it's, let me just say that this is not a high probability strategy. However, this is a very low risk strategy, and the returns are generally much larger than the risk that you put on. So, from that perspective, it has an actual positive expectancy in the long run. High probability trades can be a real problem. I mean, they can feel great while you're making tiny little profits along the way. But then when you get hit with one of those moves that violates one of the legs and it has huge risk associated with it, your high probability trade turns into disaster. At least with this system, if you can do a 50% or better, then you're doing very well. And that's really what we're aiming for. We're trying to do 50% or better. Now, in the beginning, we were on a roll. We were doing about 85, 90% for like the first, I don't know, 17, 18 trades. And then it slowed down a little bit. And then the last half of these trades have been really low. I think we've probably been more like 40%. But if you average it all out, we're still well above 50%. Oh, yes. Iz says he just watched one of my videos about hanging trades. So I was an institutional trader, and hanging trades was one of the things we always did. You would be playing your strategy, and then you never know what's going to happen. So you put something that is super out of the money, maybe one, two standard deviations out of the money, thinking that it's never going to hit. It's maybe, is it going to hit overnight? It's never going to hit overnight. It never does that. And then sure enough, there'll be some move, whether you're in gold or the index or a currency, and you get a position that you'd never thought you would ever get. And those trades end up making a lot of money. There used to be a trader when they had the open cry on the S&P and the Chicago Mercantile Exchange. There was a trader they would call number one, and he was the biggest trader out there. The way he got started was he was actually kind of a failure in the beginning. He was trading gold, and he went home one night and had left a trade on, and he was down to his last, I don't know, a couple $1,000. He came in the next day, and his trade had made $50,000, and that put him onto, gave him new energy, and eventually he became the number one volume trader on the S&P index, or S&P E-mini futures, actually. And they used to call him number one. That's how he got his start, by hanging a trade and that he wasn't even aware of. Yeah, we got 1 minute. Will it get down there? It looks like it wants to. Yeah, I think 3,900 is the level that it's probably going to pin at. Yeah, right at 3,900. Right at 3,900. Look at that. All right, that's it. So a little bit short on that. That's okay. What did I waste? I wasted $50. That won't kill me. But I think that's going to, let's see, if we look at the record now. What is the record? So this was the record prior to 24 wins, 15 losses. So now it's 16 losses. Still better than 50%, probably about 60%. Yeah. And then the next trade will be number 51. Just get it set up for now. There you go. Yeah, so that's let's see, what is, do the calculation. I think it's almost 60%. So that would be 40, 24 divided by 40 is exactly 60%. So the first 50 trades, we did 60%. There were 24 wins, 16 losses, 10 no trades. You know, I mean, if you were to do that day in, day out, year in, year out, you would be a very successful trader. Having, the one thing I think for some traders that is hard for them to take is going through losing streaks. And with a low probability trade, but high return, you're going to have a lot of losing streaks, and they're probably going to weigh on you if you don't have a long-term outlook. But if you know that you have a positive expectancy, that you're limiting your risk to very tiny amounts, and that your potential return is much larger, if your average return happens to be 150, 200% of your risk, you're going to do very well. If you can do 60%, you're going to do darn well. So let's see. It says that he got a winner. And Steve Weil nailed it. $135 in, $1,200 out. Awesome. Fantastic. Love to see that. So that's the deal with low probability trades. Now, high probability trades, what most people are trying to push out on the internets and for retail traders, it placates them. It placates them because they get a lot of small wins and they feel like they're doing something big. But in order to get that high probability trade, you need to risk a lot of money. I risked $50. Now, had it landed inside there, I had the potential of making $500. Now, making $500, if you wanted to, what would you have to risk in order to have the opportunity to make $500? Let's say it's even just part of that, $100. Most people are risking 10 times, or let's say 5 times what they are going after. So you'd risk $500 to make $100, right? So for that same $100 that I make with 50, you may have made it with using $500. The difference is if you lost, you'd be losing $500. I would only be losing 50. Now, my trades don't happen as often. They don't hit as often. You may be hitting 75, 80% of the time and making menial profits. But when you hit a loss, you're hitting big and it's hurting and it's giving you big drawdowns. With low probability trading strategy, you're not getting those big drawdowns. You get tiny little drawdowns. So you make advances in your trading capital. You tend to trade like sideways and like this, and then another step up, then sideways, and then another step up. Occasionally, if you have a losing streak, you might get a tiny little drawdown, but that's about it. So that's the difference. The other difference is that when you're in risk and your trade is going against you, I guess it's all relative. Over time, you're going to get used to, risking hundreds or thousands of dollars. But with this strategy, you're never really in an anxious moment because you're only risking a small amount. What you have to get over is just the acceptance of more losses for potentially much larger wins. Now, and randomness is kind of a weird thing, that random walk, and you never know exactly what's going to happen. So I did a study with a simulator that I created simulating our strategy. And I wanted to find out, well, what happens if I trade the E-mini S&P given the high commission and with a minimal size account. So I looked at starting with a $3,000 account, a $3,500 account, and a $4,000 account. And I found that $3,000 account, the reason why I was doing this is because I know that um, with Thinkorswim, with TD Ameritrade, that once I get down to $2,500, they stop my ability to trade futures. So they won't allow you to trade unless you have at least $2,500. So that's my cutoff point. How often do I hit $2,500 before I'm, out of luck and I have to replenish my account? So starting with a $3,000 account, about 30% of the time I get stopped out. Starting with a $3,500 account, about 16% of the time I stop out. Starting with a $4,000 account, I stop out about 7 or 8% of the time. Starting with a $5,000 account, I get stopped out twice on 100 tries. So that tells you, for trading this strategy and a relatively small account, you can have a positive expectancy with about starting out with a $5,000 account. And that if you follow the rules and your strategy, you should do well over time and you'll have really good return. Now, I did this exact same thing last year. I started with a $3,000 account just to show that you could. So I was part of that 65% that made it through and didn't get stopped out. And I was able to, after 9 months, turn 3,000 into 9,000. So that's possible. Now, it could have been one of those instances I could have just as easily have stopped out at $2,500. Then I would have had to refund the account or just, bite the bullet and just put like $10,000 in there. But I wanted to prove that you could do it, and you can definitely do it. It just means that you have to have the discipline and accept that it's a low probability trade and that you're not going to take big losses. You're going to have small drawdowns, but your advances are going to be big. And once you get going, you can catch a groove and take a small account to very large. So that's the deal. Let's see, what was this? Oh, Steve has a correction. His bad was $1.95 or $195 in and $1,200 out still. I mean, that's fantastic. And JP says in 45 cents or for $45, out $80. Walter says the other way to wipe out weeks of small wins with one max loss trade. Right. Well, first of all, what is a max loss? If your strategy has a max loss of only, under $100, you'd have to have a pretty small account to wipe it out. If you're playing the low probability strategy, if you're playing the high probability strategy, you naturally have to have much larger risk. So an example of this is other people that do the zero DTE trade, they use iron condors, and they'll typically put one on that will have 10 times the risk as the potential profit. So in other words, their trade will be using about $1,000 of margin to make $100. Now they don't even go after that $100 because they set stops and then they get out. They have a profit take rule that they get out when they get 50%. So they're using $1,000 to try to make $50. Now, of course, you can scale that $2,000 to make $100, but still, it's like a 20-to-1 trade. If you get stopped out, or if you get to max loss, yeah, you could wipe out or take out literally months worth of returns that way. With this trading methodology, that would never happen. Or I suppose it could happen, and you could go on this unbelievable losing streak, and it can. As a matter of fact, in doing this simulation, out of 1,000 different tries that I did on the simulation, I found that there were maybe 2 or 3 times out of thousands, or about 1,000 times that I did it, where even after you started moving up, there was some instances where it moved down and then stopped you out. And I suppose that could happen. But those are the 1 or 2 in 1,000 shot, 1 in 500 shot where that would happen. So it's possible, even with that type of strategy. But that's the same thing as saying that, do the coin flipping test with 1,000 people. And then all the winners of the flip will go on, right? So the first flip, 500 people are out on average, right? Second flip, 250 people are out, 250 left. Third flip, there's 125 left. Fourth flip, there's 63 people left, or 64, let's say, right? Fifth flip, there's 32 people left. Sixth flip, there's 16 people left. Seventh flip, there's 8 people left. Eighth flip, there's just 4, and then down. I mean, it would take 9 flips before you get down to those people that won every single time. So there was 2 people out of 1,000. They'd have to hit 9 times in a row, flipping a coin, and that's how they got there. So that's basically analogous to this. That it takes an incredible streak of good luck or bad luck to end up in that situation. That 1 in 1,000 or 1 in 500, and it will happen. Out of 1,000 people, there will be a couple of people that will have that kind of luck, good luck or bad luck. That's the way it goes. And there's not much you can do about it. So, that's why you can't give any guarantees, even in, the only kind of guarantee that you could ever have is if you had a contract or an annuity or a government bond. That's about as good a guarantee as you're going to get, but your return is always very, very small. So there you go. Now you trade the other way, and there's almost a certainty that in a relatively small amount of times that you're going to blow up your account. So, and Nassim Taleb actually did and I've talked about this before. He made this analogy in his book. I think it was Fooled by Randomness, that showed the difference between a highly asymmetric, low risk, high reward way of strategy, and then kind of like the lottery, and the other type of reward, the other type of system where it's very low or high probability, but huge potential risk. And if you took them out to their natural extremes, their ultimate extreme, the low probability trade always comes out on top. So it has a positive expectancy. So that's kind of interesting, I mean, ultimately, what do you want to do? Now, some people think that they can take the high probability trade and defeat risk. And no matter what happens, they will never allow themselves to get into the risk of ruin. And that's, I guess that's a wonderful way to think. And if you think you can do that, then go for it. The problem is that nobody really does that. If they did that, then there'd be a lot more people winning. The other thing is, you can look at the people who are winners, right? The people who are winners in life, the entrepreneurs, the billionaires, the real estate moguls, all of them are taking very, very small risks, very tiny risks, low probability, but they're putting just a little bit of money into their idea, into their bet, right? An entrepreneur does the same thing. They put up $1,000, start a company, turns into $1 billion company. You write a book. What does it take for you to write a book other than your time and send it out to a publisher? And it may or may not turn out well. If it does, you're famous. Virtually any endeavor where people are successful, the most successful people, they fail a lot. That's because they put in tiny risks for huge outsized gains. So why shouldn't it be any different with your trading? It really isn't. So there you go. I've probably talked too much. I talked 16 minutes too much. But thank you very much for joining me. Peace to you all. And we'll see you on Monday. Have a great weekend. Take care.